Today's lesson is Chapter 14, Problem 2B. Instead of going straight to Cengage this morning, what I want to do is I want to go ahead and go to my Excel spreadsheet because there's some terms that we need to talk about before you can do Problem 14-2B. So if you'll hold on just a minute while I share the screen. All right, what you should be seeing now is an Excel spreadsheet that I prepared with some terms on it that are related to Chapter 14, Problem 2B. First of all, we're going to be working with bonds, and so you need to know what a bond is. And a bond is just simply a note that's going to require your company to pay back interest to the owners of the bond. And those owners are what we call bondholders. They're also the creditors of the company. So what our corporation is going to be doing is they're going to be issuing bonds or selling bonds to the bondholders to raise money for their corporation. On the bonds that we're going to be looking at, they're going to have specific terms with them, and it's important that you understand what these terms mean. One term that you're going to see with this particular problem is the term effective rate of interest. I want you to know that the effective rate of interest is also what we call the market rate of interest. That's the rate of interest when the bonds are sold. And this rate is determined from sales and purchases of similar bonds on the market, and it's driven by market conditions. It's driven by the expectations of the investor about current and future economic conditions of the company. So there's going to be what we call a market rate of interest, or the same thing means effective rate of interest. But these will be written in the terms of the bond. If the cash that is received from the issuance of the bond is more than what we call the face value of the bonds, we're going to record those bonds at what we call a premium. So in other words, when we sell our bonds, there might be a difference between what we call the market rate of interest, that's what the bonds are selling for currently, and what we call the stated rate of interest, which is also known as the contract rate of interest. And that's the amount of interest that is actually written in the contract to the bondholders when we sell bonds to the bondholders. If there's a difference between the stated rate or the contract rate and the effective rate or the market rate of interest, then the bonds will either sell at a premium for more than what the face value of the bonds are, or they will sell at less than what the face value of the bonds are, and we call that a discount. So in this chapter, you should become familiar with some new accounts that we will be using when we are solving our problems in Chapter 14. One of those accounts is what we call bonds payable. And bonds payable, this is a T account for bonds payable that I'm pointing to you on your Excel spreadsheet. Bonds payable is a long-term liability. When we sell bonds to our bondholders, we usually sell them for terms such as 10 or 20 years. Those are common terms for selling bonds. And when we sell bonds to our bondholders, what we're really doing is we're saying that we're going to pay back the face value of those bonds at the end of the life of that bond. So if a life has 10 years associated with it. At the end of 10 years, we have to pay back the amount that we have borrowed. This is a borrowing type of transaction. So when we sell the bonds, we have to record it as a liability. And because our liabilities increase on the credit side, this is where you would initially record the bond issue, the amount of the bonds that you have sold and are out there on the market. You're going to credit the bonds payable account. The bonds payable account has what is associated with it called the face value. In our problem that we're going to be looking at today, the face value of this bond issue is $46 million. So when we record the journal entry for the issuance of the bonds, we're going to credit our bonds payable for $46 million. So bonds payable will increase on the credit side. The next thing that you need to do when you're looking at your problems is you need to look to see what the contract rate of interest is and what the market rate of interest is. The contract rate of interest in this problem is 10%. What that means is you're going to pay interest to your bondholders at 10%. This 10% is an annual interest rate. And so you might notice in the bond issue that they'll tell you that they're going to pay bond interest semi-annually. So the semi-annual interest rate would be found by dividing 10% by 2. In other words, the semi-annual interest rate for this problem is 5%. 5% is what we're going to pay in interest off of the $46 million bond issue. And we will do that every 6 months. So 5% of 46 million is what we would pay in interest to our bondholders every 6 months. Now notice on this problem that they also have a market rate of interest, which is sometimes called the effective rate of interest at 11%. Since the market rate of interest is higher than the contract rate of interest, in this case, we are going to be selling the bonds at a discount. So what that means is the cash that we will be receiving in this particular problem is going to be less than the face value. And if the cash is less than the face value, then we're going to sell the bonds as a discount. Now you need to understand that the discount on bonds payable is what we call a contra bonds account. So that means it's going to have a balance that is opposite of your bonds payable. Since bonds payable has a normal credit balance, a discount on bonds payable will have a normal debit balance. It will increase on the debit side. So our bonds payable would be credited for the face value. Our discount on bonds payable would be debited for the difference between the cash amount that you actually received and the face value. Now, in this problem, they actually told you what the amount of cash is going to be. So what you're going to be doing in Cengage is you're going to be creating a journal entry on July 1st to record the issuance of the bonds. So instead of flipping back to Cengage like I normally do, what I want to do is just show you that journal entry here on your Excel spreadsheet. And then we'll go back and fill it in later so you can see where it would belong in Cengage. But the first thing they're going to ask you for is the journal entry to record the cash for the issuance of the bonds on July 1st. Now, something that's important for you to know is that the fiscal year end is going to be December 31st. So we've sold these bonds on July 1st. We're going to hold them Actually, we're going to hold them for a period of 20 years. And then we're going to have to pay back the face amount of that bond at the end of 20 years. So July 1st, 20 years later, we're going to be paying back the amount of the liability, $46 million. But on this journal entry, we are at the beginning of the bond issue. We are actually issuing the bonds on July 1st. The total amount of the face value is 46 million. So our bonds payable, which is a liability, is going to be credited for 46 million. The cash account is debited for the amount that the bond sold for, because there's a difference between the contract rate and the market rate of interest. In this case, the contract rate is less than the market rate of interest. There will be a discount on the bonds payable. If the market rate had been less than the contract rate of interest, there would have been a premium on bonds payable, or a credit to the premium account. A premium account is an adjunct account to the bonds payable account, which simply means we're going to have the same balance for the premium on the bonds payable as we do for the bonds payable account. In other words, the premium on bonds payable will increase on the credit side, just like our bonds payable will increase on the credit side. A premium is titled an adjunct account, which means on the balance sheet, we're going to add the premium and the bonds payable to get what we call the carrying value of our bonds. Carrying value is really similar to the book value of the bonds, and this will happen on the balance sheet date. Now, in this problem, they didn't ask you to do a balance sheet, but I do want you to know that these are ledger accounts. Bonds payable is a ledger account. Your discount on bonds payable is a ledger account. And if there were a premium on bonds payable, it too would be a ledger account. So those are going to end up on your financial statements. Bonds payable is a liability, so it's going to go on the balance sheet. Your discount on bonds payable will go right underneath the bonds payable on the balance sheet, and it will offset the bonds payable because it is a contra bonds payable account. And again, on the balance sheet, when we get ready to do one, we'll have the face value of the bonds payable listed, less the discount on the bonds payable, and whatever's left over is the carrying value, which is similar to book value that we've discussed when we were talking about long-term types of assets or plan assets. So getting back to our journal entry, our cash amount was given to us. We have issued bonds, which are liabilities to us. So we got to credit the bonds payable for the amount that the liability increased, which is 46 million. We would debit our cash because our bondholders have paid us cash of 42,309,236. The difference between the face value and the cash amount has to be a debit to get our journal entry to balance out. So you could call this a plug figure if you wanted to, but you will know that there's a discount because the cash you received is less than the face value. And I've got that explained to you up here in this part of the spreadsheet. So you'll want to study these terms carefully so you'll understand what is going on. So this is your first journal entry that you would make to record the issuance of bonds at July 1st. At the end of the fiscal year, we're going to calculate our bond interest. Our bond interest is going to be paid every 6 months. Pay attention to what is stated in the problem, and they will always tell you that the bond interest is going to be paid semi-annually. So the bond interest rate, annual rate is 10%. So half of that would be the semi-annual interest rate. To find the amount of the bond interest, you would take the face value of the bonds, which in this case is 46 million. You would multiply it by the semi-annual interest rate, which is half of the contract rate, 5%. And then that, whatever that gives you, is the amount of interest that you'll be paying every 6 months. Now, before we calculate the bond interest payment, the first payment would be on December 31st, which is also the end of this company's fiscal year. Before we calculate that bond interest payment, I want to talk to you about what is called the amortization of bond discounts and premiums. In this particular example, we are not working with a premium. So what we will be doing is amortizing bond discounts. And what amortization means is that you're just going to write the bond off, the discount amount, write the discount amount of the bond off over the life of the bond. So you need to know that bond discounts or a bond premium, if you had one, are going to be amortized or written off over the life of the bond. So usually we do that at the end of the fiscal year. So in this case, since we issued the bonds in July, the end of the fiscal year is December 31st. So exactly 6 months later, we're going to amortize this bond. Something else that I wanted to note about when you're amortizing a bond discount, to do the amortization entry, you're going to need to reduce the discount by crediting the bond discount account, and we will debit the interest expense account. And in other textbooks, I've learned it as bond interest expense. So if you would hear me call it bond interest expense, I'm really just talking about interest expense. In this textbook that you're using, they just call it interest expense. But when you are amortizing a discount, you're reducing the discount. You'll remember that the discount was a contra bonds account. So discounts normally have debit balances. If we're reducing a discount, we would have to credit the bond discount account. And to go with that, instead of using amortization expense, we use an account called interest expense. So interest expense would be debited, our discount on bonds payable would be credited, and that's how you amortize a discount on a bond. If there were a bond premium that we were working with, in other words, if we sold the bonds for more than the face value, we'd have to record a bond premium. You'll remember the bond premium was an adjunct account, and it's added to on the credit side. So when we're amortizing the premium, we've got to reduce that premium account by debiting the bond premium account, and then we will credit the interest expense account. And that's how we would calculate the journal entry for amortization of a bond premium. Now, something else that you need to notice about a bond discount is we amortize it over the life of the bond. And so the carrying value or the book value of the bond is going to increase up to the face value by the end of the life of the bond. If there had been a premium, the carrying value of the bond will decrease. It's exactly opposite of a discount. It's going to decrease to the face value of the bond by the end of the life of the bond. These are important things that you need to know really before you are working with a bond issue. So I'm going to look next, and we're going to work on requirement number 2 in Cengage. And again, this is problem 14-2B that we're working with. And you can see here that I've listed for you the face amount of the bonds. This was a given amount in Cengage. It was $46 million. Again, the contract rate of the bonds, which is also called the stated rate of the bonds, is a given amount at 10%. That's the annual rate. We're going to have to convert that to a semi-annual rate because we're actually going to pay bond interest semi-annually. So you'll remember that we talked about converting this to 5% because that would be the semi-annual rate in this instance for this particular problem. The effective rate of interest, or the market rate of interest, was 11%. This 11% market rate of interest is also an annual interest rate. So most likely when we are calculating the cash amount of the bond issue, which we're going to do later, not in this particular part of the transaction, but we're going to do this in just a minute. We're going to use the market rate of interest when we calculate the cash if it is not given like it was in this particular problem. What they're asking you for in 14-2B, requirement 2, part A, they want you to journalize the first semi-annual interest payment and the amortization of the bond discount at December 31st of this year. Now, as an instructor, I like to show students that you can calculate the semi-annual interest payment separate from the amortization of the bond discount. I like to show you this way because I think it makes more sense to you. But in Cengage, unfortunately, they want you to combine both of these entries together and just make one journal entry. So you'll only have enough room in Cengage to make this as a combination entry. But I do want to talk to you about how it's calculated separately, because in the real world, we could have calculated these separately and just made two separate journal entries out of it, which I think is more understandable. So in the first journal entry that I've got illustrated here, what we're doing is we're journalizing the first semi-annual interest payment. Remember, the end of the year is December 31st. So we want to get all of our bond interest calculated in the time period that it belongs in, so that we can match our revenues with expenses properly on the income statement. And I might tell you that this bond interest expense account will show up on the income statement as an other item in the other revenues, other expenses category on your income statement. Notice the bond interest expense is going to be debited for the interest payment because our expenses are increasing. We're going to debit them for the amount of $2,300,000. The way I got that $2,300,000 is I took the face value of the bonds and I multiplied it by the contract rate of interest. Remember, we pay interest semi-annually, and in the issue, it's stated as an annual rate. So we have to divide this interest rate by 2 to get 5%. So if you multiply 5% times 46 million, that's how we get the amount of $2,300,000. That's what we would debit to our interest expense account, and we would credit to our cash account, because that's the amount of the payment in interest that we have to give to our bondholders. Because bonds are liabilities, we pay back interest. And the amount of interest on this particular bond issue is $2,300,000. Again, I got that by taking the 46 million and multiplying it by 10%. That gives me $2,300,000. So that's how you do the journal entry for the bond interest expense. The amortization entry of the bond discount is going to write off the bond discount over the life of the bond. So what we're going to do is we're going to take the discount amount, which we calculated in the journal entry on July 1st. That discount amount is $3,690,764. We're going to divide that amount by the number of periods in the life of the bond. Since there are 40 periods in the life of the bond, now this is how I'm getting this. The life of the bond was actually 20 years, but since we pay interest semi-annually, and since December 31st is 6 months from July 1st, our first amortization entry would be for a half a year. The total amount of the discount would be divided by the number of periods in the life of the bond, which in this case is 40 periods. So one period is equal to 92,269. Our discount on bonds payable is going to be credited to reduce the bonds payable account by 92,269, and we will debit our bond interest expense. Notice on line 58, I've given you a hint that says, or you could enter the combined entry, and that's what they wanted you to do on Cengage. So on Cengage, we will be entering this combined entry on Cengage. And so notice what they've got here is bond interest expense. The amount of bond interest expense is debited for the interest payment of $2,300,000, plus we debit it again to reduce, or excuse me, we're reducing the bond discount, but we're increasing our expense account. So these two are added together to get the total debit here to the bond interest expense account. The expense account was debited twice, so we add them together to get the total amount of the debit. Then we credit our cash for $2,300,000, and we credit our discount for $92,269. So just to double check, you would add your credits together to make sure that they equaled your debits. This is the combination entry of these two. And in Cengage, they wanted you to use the combination entry. But I think it's easier if you do two separate entries, and you would get the same amount by the time you posted to your ledger account. But this is what they wanted you to put in Cengage, so that's what you got to do in order to get your Cengage problem correct. Also in problem 14-2B, in requirement 3, they wanted you to find the total amount of interest that was going to be recorded in the first year. Now, in the first year, the amount of the bond interest is coming from the total amount of the debits to the bond interest, which is $2,392,269. That's how we get this amount right here. That is the interest expense, and that would actually show up on your income statement in the other revenue and expense category. On your balance sheet, they didn't ask you to do this, class, but I just wanted to demonstrate it to you so you'll understand what I'm talking about. On your balance sheet, at December 31st of year 1, the bonds payable account face amount is $46 million. Bonds payable will keep that $46 million amount in it throughout the life of the bond until you pay the bond back at the end of the 20-year life. So bonds payable has in at 46 million, and that's what would show up on our balance sheet. Since this was a problem that used the discount on bonds payable, or we had a discount on bonds payable, what I did in this part here was I combined my total amount of the discount that we found in the issuing entry, which was $3,690,764. I combined it with what we reduced it by when we amortized that, so that the balance of this account is going to be reduced by $92,269, which will leave you with the remaining balance of $3,598,495. This is the balance at December 31st of the discount on bonds payable. Notice the difference between the face value and the discount on bonds payable will leave you with what we call the carrying value of this bond issue, which is now $42,401,505. If I showed you all the years for 20 years, over time, this carrying value would rise to 46 million at the end of the 20-year life of the bond. So when there are discounts and we're amortizing discounts, we are reducing the discount, which will increase the carrying value each year back up to 46 million at the end of the life of the bond. Also on here, if you would have had a premium, you would show it on the balance sheet similar to this. Notice that the premium is an adjunct account, so we would add the premium to the bonds payable to get the carrying value on the balance sheet date. We did not do a premium in this particular problem, so you didn't need to put anything there. I just wanted to show you what would happen on the balance sheet for these. Now, in Part B of problem 14-2B, requirement 3, there's a Part B category. No, I'm sorry, it's from requirement 2, there's a Part B category. But they want you to do another amortization entry and a semi-annual interest payment entry, just like we did earlier. So the only difference is this is at July 1st. So from December 31st to July 1st of the second year of the life of this bond, you're going to have to make another bond interest payment, and you're going to have to amortize the discount. Notice this journal entry is exactly the same entry that we stated up here that we would put in Cengage on December 31st. It's the very same entry. None of the amounts would change. In the last part of this problem, what they're going to ask you to do is to calculate the present value of the bond issue. And I think they just wanted you to see mathematically how you would calculate the amount of cash in the bond issue. It didn't make much sense to me because they'd given you the amount of cash, but they just want to make sure that you know how to calculate that. So if you were in the real world, you would know how to calculate the cash proceeds of a bond issue. Before we can do that, we need to talk about some things that are related to the present value of a bond. And first of all, present value is the time value of money. In other words, our money has interest associated on it, and so there's a time value associated with the money that we are using in this particular problem. We're going to use the present value tables to calculate the price that the bonds are issued for. The price that they're issued for is the cash amount that would be received by the company. And in order to do this, it's going to require two steps. The first step is that you have to calculate the one-time payback amount or the lump sum amount of the face value. The one-time payback amount would be $46 million in the example in this particular problem that we're paying back. So what they want you to do is figure out what is the present value of that $46 million amount in today's terms. And so the first step in calculating the price that the bonds are issued for is we've got to calculate the present value of the one-time lump sum amount or the face value. The second step is to calculate the present value of a series of interest payments called the annuity. So every 6 months, we're going to have to pay back interest to our bondholders because these are a series of equal payments. We call them an annuity. So I've got a notation here. When we talk about present value, you always have to use the present value tables to determine mathematically what the amount of the cash is going to be. So when using the present value tables, you need to make sure that you use the market rate or the effective rate of interest. When you're calculating present value, we use the market rate of interest, not the contract rate, but the market rate of interest. Remember, in our bond issue, the market rate of interest was given to us at 11%. That was the annual interest rate. Now, something that you also need to remember when you're calculating present values, you go ahead and convert those annual rates to a semi-annual amount because we pay back interest semi-annually. Our lump sum amount also is going to require semi-annual interest when you're calculating present value. So in step number 1, when calculating the present value, the face amount, we're going to use the present value of a dollar table. This table can be called the lump sum table because the face amount is a one-time amount that will be paid back one time at the end of the life of the bond. When you are calculating the present value lump sum amount, you're going to first find the table value factor. We're going to be using tables that are given to us in Cengage to determine what is called a table value factor. And to do that, to use that table, we're going to find the table value factor amount by scrolling down the present value of a dollar table, the lump sum table, to the number of periods in the life of the bond. In this case, the life of the bond is going to be 20 years, but because there's semi-annual interest associated with this, we're going to make the periods in the bond 40 periods. We're going to multiply 20 by 2 because it's a semi-annual amount that we're going to be paying back in bond interest. So we're going to find the number of periods in the life of the bond, which in this case would be 40 periods. And then we're going to scroll across to find the market rate of interest column. So we'd scroll across to the market rate of interest, which was 11% annually divided by 2, which would be 5.5%. On our table, we're going to look for 5.5%, and we're going to look for the number of periods to be 40. Where the rows and the columns intersect on the table, that is the table value amount that you're going to use. then you're going to multiply that table value factor by the face value to get the present value of the face amount at the bond issuance date. In step number 2, when calculating the present value of the interest payments, we're going to use the present value of the annuity table, which is the PVA table, because interest is a series of equal payments. A series of equal payments is the definition of an annuity. We're going to use the annuity table in step number 2. We've got to first find the table value factor by scrolling down the present value of an annuity table to the number of periods that you will be paying interest. Again, the number of periods are going to be 40 periods because there was a 20-year life. The interest is paid semi-annual. Multiply 20 times 2, that will give you 40 periods. Then you're going to scroll across the present value of the annuity table to the market rate of interest column. The market rate of interest, again, was 11%. So we're going to divide that by 2. The market rate of interest for a semi-annual interest payment would be 5.5%. Where the row and the column intersect is the table value factor amount. You're going to multiply this table value factor amount by the interest payment to get the present value of the interest payments. And finally, in step number 3, we're going to add what we got in step 1 to step 2, and that will give you the proceeds of the bonds that were given. So again, in problem 14-2B part 5, we're going to determine the present value of the cash amount of those bonds that were issued. So at the bottom of this page, I've got this calculated for you. So step 1 is from our instructions above. The table value is going to be 5.5%. That's the semi-annual market rate, and it's going to be for 40 periods. You're going to look this up on the present value of the dollar table. This is the table value amount that you will find. That amount is going to be multiplied by the face value of the bonds to get the present value of the face amount of the bonds. This is step 1 right here, which I've got it highlighted, not highlighted, but a box around it. It's in a box here. 5,403,160 is the amount. Step number 2 is to determine the present value of the interest payment. We do that by taking the face value of our bonds times the semi-annual interest rate, which will give you the interest payment every 6 months. This semi-annual interest rate is really the contract rate of interest that they're talking about at this part. So we have to find out how much interest was paid back every 6 months. So it's 46 million times the contract rate of interest, which is half of 10%. That's how they got the 5%. This is the interest payment. It is not the present value, but it's the interest payment. Then we have to determine the present value of this interest payment, which makes us use the present value of the annuity table. We're using the market rate this time, which is 5.5%, half of 11% for 40 periods. That's 20 periods times 2, which is 40 periods. To find the present value, we need to know what the table value amount is. Our table value amount is 16.04612. That's the intersection of the row and the column at 5.5% interest for 40 periods. This comes from the table. That table value times the interest payment is going to give you the amount of the present value of the bond interest payments. The present value of the bond interest payments is $36,906,076. The final step is to combine step 1 and 2. So we're going to add the $5,403,160 to the $36,906.76, and that will give you what you're going to enter in for the part 5 of problem 14.2b. This is the total cash that was from the issuance. Notice this amount is equal to what we started out with, what they gave us as the cash amount that we started with. So the next thing that I want to show to you is just the amounts of the journal entries that we would place into the Cengage account, or the Cengage problem that you would be working on. So I'm going to flip over to Cengage, and I'm going to record the amounts in there from this spreadsheet. Now I'll give you a copy of the spreadsheet for your benefit so that you can look over this and you can study by it, because you're going to need it. This is kind of a difficult problem to do without us meeting face to face, but this is about the best that I can do for you. So I thought I would just type out everything that I felt like you needed to know. So study over this Excel spreadsheet. It certainly will help you, and I'll make that available to you to be able to look at and to print off even if you want to. So bear with me for just a minute. I'm going to stop sharing my screen with you, and I'm going to go to Cengage, and we're going to start flipping back and forth. Okay, so all the given information is right here, and I've repeated that for you already in the Excel spreadsheet, so I know you can read this and see that this is the given information. So I'm going to go on to requirement number 1. We're going to journalize the entry to record the amount of the cash proceeds from the issuance of the bonds at July 1st in year 1. For a compound transaction, if an amount box does not require an entry, you're going to leave it blank. All right, so we're just recording the cash proceeds. So when we issue bonds, we're going to be receiving cash. So I'm going to debit my cash for the amount of the bond that we received. That was given. And this is also what we call the present value of the bond issue. So it's $42,309,236. The next thing that I'm going to do is I'm going to show you the credit to bonds payable. We always credit bonds payable for the face value of the bonds, which is the issued amount. In this case, it's $46 million. Now you can use this middle part as the plug figure. In order to find the plug figure, what I would do is I would look at the face value, and see how much cash we received. Notice we received less cash than the face value that we're going to have to pay back at the end of the life of this bond, which is $46 million. We received less cash, so that means we discounted the bond. We sold the bond for less than the face value amount. So the account that I would need to debit is the discount on bonds payable. The difference between these two is the amount that I would debit to my discount on bonds payable. So I'd take the 46 million, I would subtract out the cash that I received from that, and it's going to leave me with 3,690,764. This entry I've recorded on your spreadsheet. In the second entry, they want you to record the first semi-annual interest payment and the amortization of the bond discount using the straight line method. The straight line method is used for amortization, which means we're going to divide the number of periods into the bond discount to get the amount of the amortization. So from our spreadsheet, we would find the amounts that we would need to record here. First of all, we're going to be debiting interest expense because we're going to have to pay interest to our bondholders. The amount of the interest expense, and it's calculated on that spreadsheet, is going to be 46 million, the face value, times half of the contract rate or the stated rate of interest. Half of the stated rate is 10, the annual amount was 10%. Half of 10% is 5%. So I'm going to be multiplying 46 million times 5%. What that will give me is the amount of cash that I'm going to be paying as my interest payment. My cash is going to be decreasing by $2,300,000. Because I am also amortizing my discount, my interest expense will not just be $2,300,000 like we've got recorded here. The interest expense is going to have to be debited by the amount that I have amortized my discount. And so my discount was $3,690,764. I'm going to divide this amount by the number of periods in the life of this bond issue, and since we pay interest semi-annually, the number of periods will be 40 periods. So I'm going to divide this by 40 periods, and that will give me the amount of my bond discount that I amortize. A discount on bonds payable normally has a debit balance, but we're going to credit it for the amortization of that amount, and the amount that we calculated was $92,269. They also wanted you to round to the nearest dollar. The total of both of these together is the debit to my interest expense account. Again, this was recorded on the spreadsheet, so if you need to look back at it, please feel free to do that. Study the spreadsheet that I give you. In this B part, the interest payment on June 30th in year 2 and the amortization of the bond discount is going to be exactly the same transaction that we did earlier. So we're going to debit interest expense for the same amount, $2,392,269. We're going to debit our discount on bonds payable, we're going to credit our discount on bonds payable for $92,269. And then we're going to credit our cash account for $2,300,000. It's the very same entry as this one. Refer to your Excel spreadsheet if you need to. Now in part 3, they tried to trick you here. They want you to determine the total interest expense only for year 1. See, this went into year 2. So year 1, the amount of the interest expense was this amount right here that we recorded at December 31st of year 1. It's $2,392,269. And then in part 4, they want you to answer this question. Will the bond proceeds always be less than the face amount when the bond's contract rate is less than the market rate of interest? If the contract rate is less than the market rate of interest, the bonds are selling at a discount. So the answer to this is yes, it'll always be that way. The bond proceeds is the cash amount. Will the cash amount always be less than the face of value when the contract rate is less than the market rate of interest? The answer to that is yes. And then finally, in the last part of this problem, they want you to compute the price of the $42,309,236 that was received for the bonds by using either table 1, 2, 3, or 4. I don't know why they gave you 4 tables. You just need to use 2 tables. Remember, on your Excel spreadsheet at the very end down there, I've shown you that it takes 3 steps for us to calculate the price that we're going to be receiving for the bond. In the first step here, we want to find the present value of the face amount. The present value of the face amount is the present value of the lump sum amount. We'll use table 1 or table 2 for that. When you click on this table 1, it will take you to another page showing you the present value of the dollar table. This table 1 is the lump sum table that you will use to find your table value amount. When calculating the lump sum amount, we're going to need to know what half of the market rate of interest is for this problem. The annual rate of interest, market rate of interest, was 11%. Divide it by 2, that will give you 5.5%. We're going to go down 40 periods and across to 5.5. Do you see that the table value amount is 0.11746? This is your lump sum amount table value. So if you'll pick up this table value, then you will multiply this table value amount by the face value of the bonds, and that will give you the present value of the amount of the bonds. So write this down. The table value amount is 0.11746. Again, the market rate of interest was divided in two to get 5.5% interest. We go down the number of periods to and across to this table value amount of 0.11746. You're going to need to put that into your calculator. We're going to put in 0.11746. Then we're going to multiply that by the face value of our bonds, which was $46 million. And that's going to give you the present value of the face amount of $5,403,160. To find the present value of the semi-annual interest payments, we've got to first determine what the amount of the interest payment is. And you might remember that when we credited cash up here, that was for the amount of the interest payment. We got that by taking 46 million and multiplying it by half of the contract rate of interest, which was 5%. And so 40 million times 5% will give you the amount of the interest payment, which is 2,300,000. We will pay interest every 6 months, so it's what we refer to as an annuity. So we have to use the annuity table in step number 2 to find the present value of the semi-annual interest payments. The annuity tables are table 3 and table 4. In this problem, you're going to look at table 3, and when you click on table 3, it's going to give you the present value of the annuity table. Remember, we're using the market rate of interest, and half of the market rate of interest was 5.5%. We're going to go down for 40 periods, and that's going to bring us to a table value amount of 16.04612. That's going to be multiplied by the interest payment, and that will give us the present value of our interest payments. So the interest payment was $2,300,000. We're going to multiply that by our table value factor, which was 16.04612, and that will give you the present value of our semi-annual interest payments. It's 369, or excuse me, it's 36,906,076. if you combine both of these together, it will bring you back up to the cash amount that was the price of the bonds. Which is $42,309,236. I know that didn't make sense to you, but let me say it again. It's $42,309,236. See, this is what you issue the bonds for in part one. That's the price that you actually receive the bonds. That's the cash amount of the bonds. They're just showing you how you would calculate that in this problem. So that's about all I want to talk to you today about this particular problem. We're going to stop here, and I'll see you next time.